now let me get into the different asset classes that I talked about in terms of kind of dissecting in this market analysis video, right? Or I call it also a market update video. Now, the first asset class that I want to kind of look at is the equities market, because I know that a significant portion of people or a significant group of investors, you're invested in the equity market, whether it's in the form of a stock account that you have, or whether it's in the form of a retirement account like an IRA or a 401k. I know that most people are exposed to the equity markets, and I know that I want you to learn and understand kind of what's going on and what could happen, right? So first, I think everyone who's involved in the equity markets has realized how volatile it got in March after the coronavirus situation kind of, came across the pond, and now it affected the United States and we were all going into lockdowns and things like that, right? So just to break it down, in March, the important thing is all of the indices. If you take the Dow Jones, the S&P 500, the NASDAQ, across the board, they had a massive, massive drop, and in the Dow Jones, we dropped more than 10,000 points within about 6 weeks or so, okay? Now, here are the important things that I want you to pay attention when I talk about this market. And I think the things that I want you to be concerned about. One, I know that there's been a bounce in this market since that drop. What does that bounce mean? Secondly, that big drop, what does it really mean? Okay, so I want to kind of dissect that. Usually in my videos, you know that I'll talk about the fundamental events, and then we'll kind of shift over and show you the charts, do a technical analysis. And in this segment, we'll try to do that. If not, there'll be a follow-up video where I'm analyzing the specific market that I talked to you about on a chart. Because I didn't want to kind of combine all of it together. So this is a good introduction, and then you can come back and watch the other video as a segment to this, okay? Now here are the important things as a trader and someone who trades the markets and someone who's been in the industry for a while that I saw. Number one, first realize that the Dow and the S&P 500 and the NASDAQ, all of these markets, they have been, before March, they've been in a 13-year bull market. 13-year bull market, okay? No matter what anyone says, no matter how many different angles you can come up with, you need to understand that is an extraordinarily extended time period for a bull market. When the average bull market in the United States is around 7 to maybe 9 years or so, we're now in the 13th year and going, right? So first, you should know, as someone who wants to protect your funds or wants to protect your profits, that market, the equity markets, is an overextended market. And here's how overextended it is, right? In 2007, October, when the big market crash happened, it was at 14,700, the Dow. Then by 2009 March, the market had dropped to like 6,600 or so, okay? A big 50% drop plus, right? I'm not going to get into exact numbers. But since then, from 6,600, this market, the Dow, has come up to about 28,000 plus. I mean, come on. If you're in that market and you've been fortunate enough to increase in value, first, I would say maybe get back some of the money that you lost, and then increase in value and continuously go year after year after year to a high of 28,000, almost coming close to 29,000, you have to understand that the highest probability direction for the stock market is for it to come down. That's why whenever something major, fundamental happens, you see a sudden, like an earthquake or a big shock wave, suddenly the market crashes. Because the primary reason, and I always teach this in my sessions on Bullionite, in my video lessons, I say that you always have to look at the highest probability direction of a market. That's how you can be part of a trade or an investment that can accumulate and grow significantly. It doesn't matter whether you're right or I'm right, because the market doesn't care about that. The market is always right. So whatever said or done, you know that this is an extremely overbought market and a long-term trend. Secondly, you know that the highest probability direction for this market is to come down. Even though, let's say if some people say, oh, well, I think it can go to 30,000. I think it can go a little higher. Okay, great. Let's say it goes a little higher. But the amount it'll go higher by is so much smaller than how much it can come down. That's what I want you to understand. So if you want to protect your funds, or you want to, cash in on your profits, it's time to think about how do you navigate this overextended market, right? So I want you to understand that. The other thing that's important is when you look at the drop that happened in March, and if you looked at it in terms, like in a good word to describe this would be like in a forensic manner, right? If you were to look at the charts, you'll see that in 1 week, the market drop took out like 9 months or 10 months of upward movement. In 1 month, it took out maybe a few years of upward movement. That's how you know that you're not ready when this thing really crashes. Because when you have a market that's gone up for 13 years and has what we call good volatility, and I've gone over sessions on that and video lessons on that, where in terms of describing volatility, there's good volatility, there's bad volatility. Volatility is good, but you need to know how to identify which will help you make money and which will cause you to lose money, right? So what we witnessed in March was that a market that went absolutely insane and had bad volatility. Because if you can drop in 1 month, like a few years worth of movement, it's telling you something. The market is bellowing out to you, like neon signs in Vegas. It's kind of telling you, watch out, be careful, find a way to protect yourself, okay? The next thing that I want you, all the viewers to understand, is once the market dropped from around 28,000 or 29,000 to a little over 18,000 or a little below 19,000, the market had a quick recovery, right? A significant recovery. But here's what's important. The recovery was not based on anything fundamental. Nothing fundamental. The recovery has been made simply based on a Federal Reserve that's willing to print money, on a government that's willing to give relief to people in order to, again, in my words, to just prop up a stock market, because as soon as the stock market drops, everyone gets so scared, right? Now, Obama administration did this, the Trump administration is doing this, you can go back in time. That's the problem. Whenever you have this market, when a market wants to naturally correct and come down, our governments, our monetary systems, not just the United States, across the world, the European Union, most Western countries, wherever they are, they want to artificially hold up a market. And in my opinion, somebody is going to pay the price for that down the road, okay? Because there's not, you may think there's, we can keep printing money, we can keep printing money, but if you really understand markets, and I also go over this in my sessions and videos and things like that about my philosophy when it comes to markets. Markets are limitless. So at one time, there won't be enough money to print to save it, okay? You just have to let that naturally happen. You should be okay with a stock market that goes from 6,600 to almost 30,000. Let it drop, let it have its mathematical corrections, and then go back up naturally, okay? So that's something that I want you to pay attention to, because on this bounce up, we've had the market come to around the 27,000 level, and you can see how it's barcoding right there, right? Going up and down, up and down, up and down, up and down. That's because that's the resistance. Now, if the market participants decide that coronavirus could extend, the post-COVID economy will not look like anything similar to the pre-COVID times, then you can have a massive crash. And if you look on a chart, this could be the second wave that can go below the low that was created in March. So that's something to keep in mind. And if you did not get out of the stock market, even in portions, I would recommend you start looking at your account and figuring out how do you protect yourself if another massive crash happens.
content is for educational purposes only. This is not investment advice from Bullionite LLC. There is always risk for substantial losses in investing and or trading through any financial instrument with or without this or any other type of advertised product. Past performances are not indicative of future results. Different types of investments involve varying degrees of risk. Specific strategies or education presented by Bullionite LLC and its associates in this video are for educational purposes only.